If you're trying to catch the next 100x meme coin, you need to understand two things: the psychology of hype and the patterns that signal when to buy and sell. Most traders get wrecked because they ignore these. Don't be one of them. Today, I'll break it all down so you can trade smarter and make real money. Trading meme coins isn't just about spotting trends or getting lucky. It's about knowing when to act, how to control your emotions, and most importantly, understanding common trends and theory behind how charts tend to move naturally based on human psychology. This would be a great point to mention. This is not financial advice. Meme coin trading can be extremely volatile, and what we are talking about today is general industry-wide concepts to keep in mind while doing your own research on entering a potential coin. Now that we got that out of the way, let's talk about how we can understand charts to help you maximize your potential. First off, let's discuss a few key tool options for the standard trading view chart layout used on most trading bots. For today, we are using GMGN. If you are new and need to get started, simply click the link below and use code Solana Memecoins to get in the action right away. On the left side of the chart, you will see a lot of options. We are only going to discuss a few today. By clicking the small arrow on the right of the box, it will open a menu with even more options. The first one is a trend line. This is a basic line between 2 points you select anywhere on the chart. Next is the horizontal line. This is great for marking levels or thresholds. Next on the left menu, we've got Fibonacci charts. These might seem complicated, but they're just tools based on a mathematical pattern found in nature, art, and even architecture. In trading, they help spot potential areas where a coin's price might bounce or reverse. Think of them as zones, not exact numbers. Explaining them fully would take a whole video, so for now, we'll skip ahead to the projection option and find price range. This tool is key for tracking price movements and understanding the chart better. It's time to put our tools to the test. Let's use these tools to digest a chart and understand the psychological thresholds, which are key points where many traders tend to either buy or sell their position in the coin, which can often cause significant price reactions. Humans are naturally drawn to round numbers, and in trading, it is no different. When a coin hits major milestones like 100,000, 300,000, 500,000, 1 million, and so on, the price likely will dip or pull back. This is normal. We actually want to see coins pulling back, as that is natural trading behavior. In cases we don't see the natural pullbacks, that is a significant red flag and very likely a scam. Like you see here, this was almost all positive candles followed by a total dump. Avoid these at all costs. Now is where the fun begins. Let's use this hood chart as an example and to try out the tools we reviewed earlier. First off, it looks like we have a positive uptrend here, using the trend line starting at the location where volume started building significantly during the last run to the bottom to where we are at now. As long as the coin can hold this trend, the price will generally rise. That trend will need to be sustained with volume and attention from the market. With a coin like this that has ran and dipped, we want to use the price range tool to confirm we are less than a 60% drop. This 60% is the rule of thumb. When the coin dips more than that, it is less likely to rebound, as the majority of holders likely have sold their positions and the coin has blown through main support levels. This one is just under with a minus 55%. Close, but still viable. Those support and resistance levels are up next, and you will want to stick around for this. Once we establish the trend and see the dip was sustainable, let's identify where the key levels of support and resistance are. Areas of support will cause the dipping coin to bounce and rebound, whereas areas of resistance will cause a running coin to fall at a common point. This will help us determine potential stop loss and take profits down the line if we chose to enter. For this chart, the current support looks to be about 6 million and resistance about 10 million, both round numbers and those psychological thresholds we discussed. Let's add our horizontal lines for these two areas to visualize this zone. Now we see the price holding around this zone. If we feel this coin has potential to run and decide to enter, these two areas we can base our exit strategy on. Setting a take profit sell at about 10 million will ensure some profit is earned even if the coins were to dip again once hitting this threshold. On the other side, the less exciting limit is the stop loss. Setting the stop loss at around 5.5 million will fully test the support level established at 6 million, and if that level is broken, it may be time to cut losses and move on. We can use our price range tool again to see how much of a loss this would be for an 8.2 million entry. For this case, it is 34%. Ideally, keep the losses less than 40%. Riding a coin to a deeper loss than that is not a consistently winning strategy. Last but definitely not least, keep emotions out of your trades. The fear of missing out gets all of us at some point, but rushing in without a plan is how people get wrecked. If you're feeling too emotional while trading meme coins, your bag is probably too big. Trade smaller so you can think clearly and make smart, level-headed decisions. There will always be another coin, so be patient, stick to your strategy, and wait for the right setup. That's a quick look at meme coin trading psychology. If you liked it, don't forget to hit like and subscribe for more.